Testing one. It's being recorded, live stream.
Good afternoon, everyone. We'll get started when we're all settled here.
Thank you. Take control. Reel 6. That's good. 1 minute after I want. So we've been through the journey. Thank you for being in there. Look forward to what happens. We'll have 15 minutes, and we'll have 7 minutes for questions. And the judges that didn't, that were on panels, we just do brief introductions.
Hi, everybody. I'm Paul Herman from HIP Investor. HIP stands for Human Impact and Profit. We rate more than 8,500 investments like Morningstar does, except they do it for historical risk return, and we do it for future risk return and impact.
Hi, I'm Lindsay Martinez. I work at Cambridge Associates. I've been on their senior management team for about 15 years. I oversee their global client service and relations, and we work with about 1,000 clients, and about 700 of them are nonprofits.
Hi, I'm Vern Sidlacek, President and CEO of Commonfund. So it's my money that you guys are competing for. Not really my money, but the company's money. But it's great to be here. We manage about $25 billion for 1,400 clients, mostly in the U.S., colleges, university, nonprofits. So.
Hello, Priya Mathur. I sit on the board of the California Public Employees Retirement System, which manages about $300 billion of assets on behalf of public employees across the state of California. And I also sit on the board of the Principles for Responsible Investment, which is a global nonprofit focusing on promulgating responsible investment among investment managers and asset owners.
And Bob Litterman, I'm the chairman of the board of Commonfund, and so I guess I'm Vern's boss and the supplier of the money here or whatever, but for the prize, and also on the investment committee of World Wildlife Fund, and client of Cambridge as well. So pleased to be here.
All right, start your engines. Go ahead.
Thank you. Good afternoon. When I was growing up, there was a day when all the kids in the neighborhood got together to play baseball, and unfortunately the Burt boys, Jacob, Josh, and John, weren't playing fair. Every ball they threw was a strike. Every ball they hit was fair ball. Unbelievable, right? Like this never happens in baseball. And all the kids and I, we had a dilemma. We could stick around and change the game and keep playing, or we could quit. We can go home, and that would be the end of it. That day, we chose to stick around and change the game and keep enjoying ourselves. That was solid advice. That was the right call for us back at that time, playing baseball. That's the right decision for Commonfund and GPSU in the game of institutional investing. Institutional investors have two main goals that they're considering: maximize long-term returns and maximize the influence over the economic climate risks. The Commonfund and GPSU are in a unique position as institutional investors to have an impact on the climate change challenge. Institutional investors, and specifically the foundations that they represent, the endowments, as they are managed into perpetuity, and the risks converge to one, the beta converges to one. Money managers' focus goes to the market risk premium. What does this do? It means that any threat that changes the market risk premium is now a direct challenge to the long-term profitability of the foundation, and is in the responsibility of the fund manager to adjust. Climate change, talking about water shortages, temperature changes, all of this is threatening to the long-term economic health of the nation and the total economy. In that sense, given that context, money managers have both a moral obligation and a fiduciary responsibility to address climate change through the assets that they represent. Today, we're here to advocate to GPSU and to Common Fund, don't take your ball and go home. Stay in the game and change it. First, we're going to outline the differences between the engagement and divestiture strategies and why we believe that the engagement strategy is a superior alternative. Next, we're going to explain the three targets for change we have what we want to highlight for our institutional investing. And finally, we'll give you the details of our action plans for both Common Fund and GPSU. Let's get started.
Walking away does not change the game. Divestment will not reduce carbon emissions in this economy. The size of total universities' asset under management or their investment in the fossil fuel sector is minuscule compared to the market capitalization of that industry. The moment you divest, someone else will take up your share, and you will no longer have a seat at the table. You will no longer be present in the room. In the past, even for a smaller sector, when the divestment campaign targeted South Africa or companies with links to South Africa, although the political statement was made and the symbolism was there, studies have found that there was no financial impact on the cost of capital for the companies. There was no impact on the macroeconomic indicators of South Africa. So even in that case, the financial impact could not be achieved by a successful divestment campaign. So hoping for any change in cost and capital in this divestment campaign is futile. What divestment from fossil fuel assets will do is that it will limit endowments and common funds options in terms of the investment managers that they can work with, in terms of the universe of stocks that they can invest in, which will hurt their returns, which will increase their risks. It will not diversify away the fossil fuel risk. It will not diversify away the stranded assets risk, because just by the nature of climate change, and looking at fossil fuel betas, the interconnectedness of the entire economy, all the sectors, if stranded assets risks do come to or are realized in the future, all sectors in the economy will be affected, not just fossil fuels. So if you're divested out of fossil fuels, you won't be saved from that risk. In terms of GPSU's unique position in the state of Pennsylvania, its links with oil and oil companies, we think that divestment has the potential to harm relationships with its donors, its alumni, the employers of its students, as well as the community at large. And by demonizing fossil fuel companies, by divesting out of them, it also doesn't address the demand side of the equation, the consumers, the sectors that are using fossil fuel, and in a way, this demonizing gives a free pass to that side. Engagement, on the other hand, we believe is the long-term strategy for a long-term problem. With divestment, you're working with your investment choices, your portfolio today, maybe grabbing a couple of headlines with the divestment that you do, but engagement means that you are able to keep the conversation alive, work with the management of these companies, join forces with other investors on initiatives, and quarter after quarter, year after year, advocate for change in this direction. The engagement strategy also provides the options to use the public voice, to use the private voice, file shareholder resolutions, bring up this conversation in boardrooms, and this comes at no impact to the portfolio. You're just working with what you own, and minimal additional costs, as we will discuss later in the action plan. Engagement does not just sound good, it is increasingly effective. Recent examples have shown that investors have been able to successfully engage with management of these corporations on specific issues, which is something that engagement has an advantage over divestment in, that you're able to target specific issues with specific companies rather than throwing a blanket on all of it. So these examples have started the conversation on specific issues with these companies. And as you can see, the trend is growing. More investors are raising these issues via the platforms available to them, as well as more management managements are working with these investors, which is seen as in the increase of number of withdrawals of these resolutions as time progresses.
So the question is, how are we going to engage? We're going to propose that there are three main tools that the Common Fund should empower its clients to use in this engagement strategy. And the three are, to keep with the baseball metaphor for a minute. First is improve the statistics, to open up the kind of Moneyball type analysis that Billy Beane was able to be so successful with, right? We need more information about carbon and climate risks. Two is end the use of performance enhancing drugs. And if you think about it, in the days of everyone juicing, you had statistics that were overinflated, just like we have today with oil company valuations potentially. So helping companies transition to a business model that will allow them to be adding value based on more sustainable, forward-looking business models is key. And then third is expanding the wildcard race, bringing more people to the table. And by that I mean, let's move away from the just looking at the demand side, and we need to be just focus on the supply side and focus as well on the demand side where, the majority of emissions actually happen. So the first of these, disclosure. There's a huge investor appetite for this kind of information, as we've seen with the new Bloomberg carbon valuation tool that was launched last week, or the EIO index, or the Carbon Disclosure Project, or the CTI. Investors want good data on climate and carbon risk. There's an appetite to invest on this information, but they don't have it. They only have third-party information. And what we would like to see is Common Fund empowering its clients to engage, to request that information as shareholders. It's in our material, it's material to our interests to demand that we have this information on a quarterly basis reported on the filing. Let's encourage the companies that we own to do that. And as we see, as we saw with the ExxonMobil example, that we can make some progress in that direction, and issuing one report's the first step, but let's keep pushing for quarterly self-reported, externally verified carbon and climate risk disclosure. Second, we want to go beyond just reporting on this information. We think that these companies have an opportunity to play a role in transforming the energy economy that they helped build over the last 100 years. I'm talking about the fossil fuel companies. And there are two real opportunities here. I mean, the first one is when you look at as a point in time, the $50 billion that have been divested so far for the university divestment campaign, compare that to what fossil fuel companies spend every year, $500 billion or more, drilling for new oil wells that may or may not ever be burnable, depending on your feelings about stranded assets. We've got 5 minutes left, so I'm going to hurry up. The point here is that we did some basic modeling, dividend discount model, and we were able to look at where are the valuations today, what's the implied growth under current market scenarios. Clean tech looks really attractive to these companies, and as fiduciaries and as owners of these companies, we would advocate that these companies explore these options, and to the degree that there are not enough profitable clean tech opportunities to invest in yet, companies should be returning capital to shareholders, and there's a really strong financial case to be made that investors can invest that money better than the $600 billion that are being spent on drilling. So with that, I'm going to, one last point. Again, the demand side is just as important as the supply side, and when you look at the carbon, the wedge theory of how we're going to reduce emissions, most of these wedges are demand side issues, not supply side. So engaging in the whole portfolio, not just with the oil and gas companies and the coal companies, but with the Walmarts and the UPSs and the advanced auto parts and the manufacturers and the General Mills. And we've seen successful shareholder engagements with these types of companies to improve their energy efficiency and improve disclosure.
It's okay. So now that we've hopefully convinced you that engagement is probably the way to go versus divestment, we'll give you an action plan for Common Fund as well as for GPSU. First, I think there is an appetite, and Common Fund should figure this out through a market validation sort of exercise with their clients about how to what extremes do their clients want to engage in the climate and carbon exposure game. The second thing that Common Fund should do is create a new climate proxy services division that will essentially help their clients sort of engage to the points that we've just laid out. So ask for better statistics, push for better disclosure and verifiable information, not just on carbon exposure, but in terms of their operational risks about, if there are water issues or if there are operational issues there. The second thing that I think we think that Common Fund should do is to help support the education of their clients in terms of the available sort of services as well as the sort of metrics that are available to make decisions. They should require existing managers to disclose carbon risks and how they treat those carbon risks as per se as part of their evaluation. And then the last part is that Commonfund should go forth and find new fund managers who are already doing sort of carbon exposure analysis, as well as look for new green funds and green bonds that we've been talking about today. And for GPSU, we think that there is a four-pronged approach here. One is to engage the student community. So the divestment movement at GPSU, as presented to us, started off as a student sort of resolution. And so to be part of the solution, we think that GPSU should engage their student body, should communicate to them the difficulties of divestment, as well as the understanding that divestment does not necessarily give you the impact that you're looking for, and that they should engage in a student-run sort of clean tech fund in energy efficiency projects on campus as well as beyond, and also communicate with their fossil fuel stakeholders. So given their position in Pennsylvania and understanding the fact that there are donors, there are employers, there are sort of alumni as well as parents and students who are interested in these issues, and that they are by staying in the game, that they're helping change it for the future and in creating a new economy. The third part is that GPSU should hold on to illiquid private equity positions until maturity, but also engage a positive screen going forward. And fourth, and obviously, if Commonfund has a climate proxy services, they should subscribe to that.
So in conclusion, GPSU and Commonfund have the same goal to do what's right for the GPSU endowment. Engagement is what's right. Engagement is staying in the game and changing it. Engagement is playing the game to win. We'd now like to open the floor for questions.
Press the button.
Green.
Okay.
Speaking to the mic.
And hold it down. All right, I got it. Can you hear me, or do I have to actually lean over the thing? Okay.
I can hear you.
I noticed everyone's getting really close to the mic. So my question is around, do you really believe that these large established fossil fuel companies can actually transform themselves, and that they are the best ones to implement new clean technology opportunities? And
General Electric used to make light bulbs, and now they make MRI machines, jet engines, nuclear reactors, windmills. Companies can evolve over time, and we see it in every industry. There's no reason why these companies with this kind of capital that they're throwing potentially down a sinkhole, literally actually down a sinkhole, but potentially never to return, shouldn't be looking at these industry adjacencies. As shareholders, it's our prerogative to suggest to companies where their capital might be better allocated, if that's synergistic investments through M&A or organic growth into these adjacencies. As you can see, these companies actually could buy the entire market capitalization of the clean tech industry in 1 year with about a third of their exploration spend. The clean tech industry, about $220 billion. So oil and gas companies could buy every single clean tech company next year instead of drilling for about 1/3 of the wells that they're going to drill. The capital is there, the supply chain distribution networks are there, the customer relationships are there, the technology and the R&D capabilities. What they don't have, they can certainly buy. So we do think that these companies have the opportunity to transform from the oil and gas companies of the 20th century into the integrated energy solutions providers of the 21st century.
To add on to that, if you think about the fact that if we attack the demand side as well at the same time, and you're transitioning away from the oil and gas as your fuel source, then not having the consumer base as well will make sure that you have to transition into different sort of ideas about what you want to be as a company as well. So,
and the last thing is the cost structures here don't look good for oil and gas. The little line graph in the middle left column versus the falling cost structures in clean tech, that's pretty compelling to me. And if I'm a shareholder, I would want the companies that I own to be looking at that.
Hi there. Thanks for this very impressive analysis. At McKinsey, we used to call this the German chart. There's not much more analysis you could fit on it. And that's a compliment. So the summary that you had talked about hard divestment versus nuanced engagement. And I guess my question is, why not nuanced divestment and hard engagement? Because essentially, you're from the LBJ school, and so President Johnson was about engagement that would range up to hard engagement. And isn't climate change an issue like civil rights, that it could benefit from that type of diplomacy?
So I would say that climate change is probably the civil rights. You could compare it to the civil rights movement of our time. There's no doubt about that. The way we broke it down was to help make a clear division between our strategy. We would advocate that these companies look at potential divestment of some of the worst actors, the lowest performers, and the dirtiest companies over time, perhaps setting carbon intensity benchmarks and divesting based on that. If, as we've seen with Mr. Litterman's swap, the returns continue to look like they do. So yes, part of the other part of naming that was, if you're thinking about this in a very pro-climate change strategic point of view, you could go for a hard engagement strategy, the other end of the spectrum, which would be divest from everything but fossil fuels, get together with people, try to take a bigger equity stake and make a bigger noise in the boardroom. But we don't think that's the right strategy for any of y'all. So.
Can you also talk a little bit about, if you move away from this piece of the discussion, but actually talk about the asset allocation and where you would generate your returns, how you would look at that in terms of marketable equities versus illiquids? So we are not advocating an immediate change to GPSU's portfolio. What I'm showing here is the current carbon exposed portions of the portfolio, and both the liquid and marketable portions. And we did some analysis with the fossil fuel betas to look at kind of what the exposure is. So currently, $19 million approximately of the whole portfolio we estimate to be directly exposed to carbon risks. That's based on MSCI World Sector Breakdown and applying that as a benchmark to GPSU's portfolio, which we weren't given information about the sector breakdown. But so that those $20 million, we're saying keep that there for now. And we're not recommending an immediate concrete change, only looking at these future options as Commonfund brings them online and makes them available. But in the near term, engagement.
Can you expand on how you think investors can actually impact the demand side and what strategies you would employ there?
Much in the same way that we were advocating it for the supply side, but what we think makes it an even more compelling case is, like, if you can we look at that abatement graph? Anyway, what it says is that 70% of the abatement potential lies on the demand side, so that's a huge opportunity. But also, all the positive ROI investments as identified by that analysis are on the demand side. So instead of, that makes it more compelling, because instead of asking the supply side to perhaps go into sectors that will, in the short term, be costly to abate climate change, we have energy efficiency options on the demand side that will also save these companies money. So real estate companies, utilities, car manufacturers, they all have, like, in terms of these projects, have an opportunity to save money directly.
I would just add that we've seen, if you go to Ceres.org, you can see 400 shareholder resolutions, of which about 80% of them have been on the demand side, Walmarts and power utility companies that are purchasers of coal and retail and manufacturing, and engaging with those companies equally as vociferously that reducing your reliance on fossil fuels is going to reduce your fossil fuel beta and increase your overall returns and our returns as your shareholders. So that argument plays across no matter if you're on the supply or the demand side.
Is there a way to evaluate over a 20-year period what this approach might have in terms of impact on CO2? Is there a way to think about it, to calculate it, to evaluate it relative to risk and return, and relative to if you don't engage?
So we tried to think about a way to do that. And yes, there's a function in theory that you could come up with, which is $1 of assets under management divested versus $1 of assets under management actively engaged on. What's the leverage over ultimate CO2? And you can kind of walk through these functions. This font is a little small. We didn't plan on presenting the slide, but we think there's definitely a way to quantify that, and that folks with a lot more quantitative firepower and larger staff and more ability to move through large data sets might be able to come up with that. But absolutely, that should be something that can be estimated and looked at and evaluated based on those metrics, 100%.
To that point, isn't the decline of the coal index over the past 2 years by 50%, 50%, literally the canary in the coal mine, and that by holding on to these positions and not underweighting them, if you're taking an engagement strategy, you just need a minimal amount, and you can underweight for the expected financial underperformance?
That's right.
Okay, thank you.
All right. Good afternoon, everybody. My name is Fedor Petrenko, and these are my colleagues David Kogan, Duncan Hinkle, Jackie Wise, and Paul Brenzel. And it gives me great honor to represent Yale School of Management this afternoon. We're going to be speaking to you about our strategy for a low-carbon future for GPSU and the stance that GPSU can take with regard to the divestment question. As you all know, divestment is an incredibly complex and multifaceted issue. And essentially the stance that we are taking on it from GPSU's perspective and from Commonfund's perspective is that we would like to divest in a gradual step-down fashion and reinvest in clean technology. And before I get too deep into my strategy here, I thought I would go over some of the main issues that we considered in making this analysis. Divestment is quite controversial, and one of the primary reasons for that is that fossil fuel-related investments are highly liquid, the market is huge, and they've generated consistent, steady returns for investors, so they're very attractive. If we consider the long term, fossil fuels will remain a significant mix of our global fuel supply for the foreseeable future, so we don't think it's realistic to divest immediately. And to follow from that, most universities in the United States will continue to rely on fossil fuels for the foreseeable future. So we think that it would be a bit of a double standard if we divested without taking action on GPSU's campus. And to speak to that, we'd like to develop a campus climate action plan to address GPSU's carbon footprint. With regard to our divestment and reinvestment strategy, we'd like to begin a transition to low carbon investments in marketable asset classes for several reasons. First, to hedge against a potentially carbon hostile future. Also because we believe that renewable investments represent a new wave and it's only going to grow from here. So we'd like to capitalize on the high returns that we foresee in this industry. As I mentioned, we also intend to green our campus infrastructure, which will also be a good investment. And we'd like to step up investments in renewables to capture the increasing growth in these sectors. To speak again to the future outlook, we know that fossil fuels are not going away anytime soon. As the developing world increases its appetite for energy, coal, gas, and oil will continue to play a significant role. So we want to be aware of that and also aware of the fact that renewables are experiencing rapid growth and we can expect that trend to continue. As GPSU is positioned to potentially be a leader in the climate change movement, we'd like to seize this opportunity and address the fact that renewable industries are not going to grow without significant investment, and that's why we propose to reinvest the funds that we divest from fossil fuel holdings. To go over the main points of our strategy again, we believe it's crucial that we respond to the students' concerns because, after all, the university is here for the students, and they have made themselves heard, and global climate change is an incredibly pressing problem, and we want to recognize the university's moral obligation as a moral authority with regard to this global issue. Furthermore, we'd like to maintain and enhance our fiduciary responsibility and the endowment's capacity to continue to support GPSU's operations and fund scholarships and capital projects. And that's why we're recommending a limited and gradual divestment strategy. And finally, we recognize the context of GPSU as being positioned in Pennsylvania with donors, alumni, and potential employers in the fossil fuel industry. So we don't want to demonize fossil fuels and potentially impact that very fruitful relationship with GPSU. In contrast, we'd like to continue to engage in practical shareholder activism to see how we can work with these companies specifically towards driving them towards increased disclosure and environmental efficiency. So to speak briefly about our Campus Climate Action Plan, in order to finance these efforts, we'd like to create a green revolving loan fund. This is a mechanism that essentially takes a round of seed funding, invests it in high return energy efficiency projects, and then takes the returns, the energy cost savings from those projects to finance additional rounds of energy efficiency and sustainability projects. We'd like to use returns from the non-marketable assets in our portfolio that we know are invested in fossil fuels to actually fund this seed round with the Green Revolving Loan Fund and to launch the Campus Climate Plan from there. And the areas that we'd like to address, so we'd like to address buildings. Most of the carbon footprint of any institution or university is the energy that's used in its buildings. We'd like to address food and water, transportation, and also to establish an education and outreach program by creating a sustainability office and an eco-reps program to channel some of the students' passion and interest in environmental issues into actionable results. And finally, to speak a little more about shareholder activism, we know that the track record for shareholder activism getting results, especially with regard to titans such as Shell and Exxon, has not always been terrific, but given the recent movements of organizations such as Carbon Tracker and the Carbon Disclosure Project, we fully believe that continued pressure on these companies to disclose will only help to get better data, and as the stigma towards pollution and fossil fuels intensifies, this trend will indeed, we believe this trend will urge them to become more environmentally sound in their practices.
So I'm going to talk a little bit about Common Fund's objectives and how they're going to get there. First, I think they need to be aware of what their responsibilities are and what their available means are. They are a manager of managers, so they cannot be moving assets around directly. They need to provide those resources that can move the assets around to the university. So in doing that, they need to select managers who meet the obligation or who have these ESG criteria in mind to their client universities. They need to understand the risks of green investing. That's kind of, the future is always uncertain, so you never know if this climate hostile future is going to come to pass, but you also don't know if it's not going to. So they need to understand that, and they need to select fund managers that are able to understand as well. They need to essentially develop the expertise in this new asset classes. They need to figure out what asset classes are out there. They need to become essentially masters in that understanding, and they need to understand how this affects climate change in the future. So here's a quick 5-step approach of what Common Fund can do to deliver on these promises that I just talked about. One, they need to monitor the performance of these outsourced investors, the outsourced fund managers, and they need to maintain awareness of their financial obligations to the universities. They need to engage with the universities to discuss what their criteria are for ESG investing, and also what criteria they have for risk and return profile. They need to discuss the expectations and implications of a carbon hostile future, and they need to make sure that the universities are on the same page with those expectations. This involves building a consensus so they can direct their investments in a knowledgeable way. They need to essentially identify the minimum required investment for these new green funds. I think the minimum number was $100 million. That also points to kind of developing this consensus among the fund managers and really understanding everyone kind of needs to be on the same page in terms of what their ESG criteria are and what their required risks and returns are to move assets into those funds and maintain their economies of scale as a large strategic investor. And finally, they need to monitor and oversee these ESG criteria and make sure that their fund managers are acknowledging that and following what the universities require of them. So here's some direct actions that Commonfund can take. First, they need to notify the universities and make them aware of this carbon hostile future. They need to implement a strategy of essentially gradual change, and they need to align their investment strategy with the campus impact plan that we discussed further. And here's a Venn diagram kind of how I would vision this. It's essentially looking at the financial obligation that Commonfund has to their investors, looking at the world through the lens of a carbon hostile future, and then by aligning those two goals, they come to this final product of carbon hedging. And we're going to talk a little bit more about the assets which Commonfund can invest in, and those assets are green bonds, fossil-free indices, infrastructure projects, PEVC, and low-carbon technologies. And Duncan will talk a little bit more about that.
Thank you, sir. So like Paul said, we've identified 4 broad asset classes that we think map pretty well onto GPSU's current portfolio that Commonfund and GPSU can use to sort of help move towards this less carbon intensive, less carbon exposed portfolio. The most marketable would be fossil-free indices, and then we move into sort of less liquid assets such as green private equity funds, green clean infrastructure investments, and green bonds. So I'm just going to speak about each of those briefly, but just before that, we envision this transition again happening gradually. So as assets reach their natural expiration, that's when we would anticipate divesting. We would move, we would try to avoid some of the fees and some of the extra expenses that come with premature divesting by sort of taking a gradual step down approach. So the first asset I wanted to discuss was green bonds. This is a large market already. It's estimated to be $44 billion in 2014. The one sort of wrinkle with this that Commonfund would have to navigate is that the underlying assets for these green bonds can be a variety of different things, and they want to make sure that the assets that are in these bonds match the priorities and of the universities in which that are using them. But the great thing about these bonds is that they frequently are almost equivalent to the normal bonds that we're used to dealing with. So they have AAA credit ratings, similar returns to the fixed income assets that we're used to. They're sort of a very accepted way of greening the portfolio and reducing carbon exposure within an endowment. Over half of GPSU's endowment is in equities, and so we wanted to find a way to sort of move some of those into less carbon exposed assets. And what we identified were these fossil fuel free and low carbon index funds. These index funds tend to track the S&P 500 and other sort of more standard index funds pretty well. You're looking at excellent liquidity, good returns. Again, this is sort of a quick and easy move that you can make without sort of having to adjust risk and return too much. We also believe that private equity and venture capital are going to be interesting things that we should be looking into when exploring these sort of green investments and low carbon investments. So a lot of the companies that are going to be moving our technology forward, enabling this low carbon future, are smaller. They need the capital investment. They need the assistance from these large investors, and PE and VC is a great way to make that happen. And finally, green infrastructure investments. There are a lot of interesting and creative ways to invest directly into assets on the ground that are sort of enabling, again, this low carbon future. And so this can be things like yieldcos or renewable energy lease funds, residential solar lease funds, ways to put money to work directly into assets on the ground. So these four broad asset classes, we believe, provide a path forward for GPSU to move from carbon-exposed assets into less carbon-exposed assets. We believe Commonfund should help lead them towards this path. We also believe that GPSU has several on-campus and local community initiatives they can take, specifically the shareholder activism and the Campus Climate Action Plan, which will position them as a leader within their community and within their investment community on these issues. And now we're open for questions.
I guess I'll kick it off again. So did you actually do any financial analysis of your approach? And could you talk a little bit about, you talked about a step-down approach to gradually divesting. Over what period of time are you talking about? And did you test it in different market environments, especially a rising inflationary environment?
So first of all, we actually looked at a step-down approach as a crucial sort of way to drive change in this sort of thing, because there are a lot of different aspects to this, and some of these shifts are actually occurring within the fossil fuel space, such as the move from coal towards gas. And I think that one of the advantages, actually, to the second part of your question, one of the advantages of an organization such as the GPSU is this sort of perpetuity outlook on its holdings. So I think that we definitely looked at things such as various scenarios coming into fruition. However, we also looked at, I would say, mainstream scenarios and several carbon unfriendly scenarios that are out there, and there is a lot of work being done by organizations such as the Institute of International System Analysis. And all of those point out basically to a great reduction in many key areas. First and foremost, things like coal comes definitely to mind, but definitely in general a reduction in the consumption of fossil fuels in the primary energy mix. That being said, there's definitely a point in terms of risk for things such as the high, for example, the high inflation scenario. However, we think that while looking at lower or towards perpetuity sort of life cycles of this investment, we think that these risks just are mitigating by the very nature of this. Sure.
I'm just, if I was sitting at Commonfund and I was thinking about my clients, each one of my clients has their own board and their own governance structure. And so one of the things I'm wondering, one of the things that you suggested is that Commonfund sort of push these boards to invest in these types of opportunities. And I'm just curious how you would encourage them to do that, because I think each board has its own trade-offs and each institution has its own constraints. So for instance, foundations have to spend 5%, universities some may spend a lot on their operations, others may not spend much. Hospitals may have debt ratings that they might need to manage. And I'm just curious, given that each institution does have its own particular idiosyncrasies or constraints, can you talk about what you might suggest to Commonfund to encourage them to move in this direction?
I think the main way I would go about that is you kind of have to align the university's expectations of the future, I mentioned that a couple times, with this carbon hedging concept that I talked about. I don't know, I wouldn't push the universities to speculate in green technology. You need to prove that the financial return is there and that you're essentially diversifying your portfolio. So I would approach it from a direction of kind of gathering a consensus on what each university and their board thought that the expectation of the future would be in terms of climate policy. And then once you have that out and you're aware of that, then you kind of move your investments accordingly, and then you can maybe engage like fund managers who are involved in these green investments.
Yeah, I think we project an increase in demand for these types of products as we enter a carbon hostile future. And so we see Common Fund as a space that's going to organize the underlying funds that then can be bought by the university. So we don't want to really push universities, we just want to get ahead of the curve that we see coming.
And we tried to identify like a broad array of things with a broad array of returns and a broad array of risks, so that hopefully within this vision of a carbon-free, low-impact carbon future, like you're able to adjust things to take into account like the various requirements of the hospital versus the university versus the more aggressive university.
All right, building on that, thanks. So thanks for your very thoughtful, comprehensive work. And you did present a broad array, but there's two fundamental questions that I didn't hear anything about. So the first one is, the metric of tracking error looks at historical risk return, and the risks of carbon are about future risk return. So would you recommend that tracking error actually isn't the right metric and that there's a different metric of future risk? So that's question number one. And then question number two, this is also foundational and fundamental. One of the pages says respect the school's ties to the fossil fuel industry because it supports the endowment and they hire students. But if you're talking about morality, what kind of respect is embedded in a threat to morality? And what kind of engagement do you need to do that? So for example, what I didn't hear was somehow influencing the boards of the fossil companies, or even training students to go work inside, so sort of like a Occupy Wall Street, but from the inside, not the outside. So if you could help explain this morality versus respect fundamental theme, and tracking error, if you outperform the tracking error by 200 basis points, most investment consultants would say you're out of tracking error, even though you've beaten the index.
Yeah, I'll take the second one first, in that our sort of central point with the respecting the fossil fuel companies is that a lot of times divestment is taken as a, we don't want to be associated with you. We're just entirely done with you. And I think what we were trying to get to was that those businesses play a role within the community that should be at least considered as we move forward here. And I think we were pretty clear in our presentation that we want to move a certain direction, but that needs at least needs to be respected as shareholders. So that was the first point, and then I believe. Go ahead. No, I believe that. Yeah, I think that there's a lot of uncertainty out there, and so the reason we use the tracking error is just to demonstrate that moving towards these indices wouldn't be as dramatic or as sort of painful as a lot of people think they are. I think it's interesting, you get out into the world and people assume, well, we can't invest in green because our risks are going to go through the roof and no one's ever going to listen to us again and then we'll lose all our money. And we were just trying to demonstrate through that that's not necessarily the case.
Where is your proof that the students are what's important to the university? Certainly, as I talk to trustees, I wouldn't say that that's one of their first comments.
I'm hurt.
First, ouch, but in general, we definitely think that the current student body represents also the sort of the future flow of alumni and also the future flow of cash into the endowment. So completely disregarding the sort of the way that the current students look at these things is, I think, not just disrespectful of the students, which is sort of beside the point. It's just short-sightedness on the side of the university.
Do you think that your plan would improve giving going forward relative to the status quo?
I think that's hard to say from the information we received in the case. So to your first point, it was actually, I think, stated in the case that the trustees said we really respect our students, we want to listen to their voice, and that was part of the underlying premise of us, finding this. Yeah, I think it's hard to find from the case whether or not this would improve giving. If we can find a way to invest in energy generation companies that then become places where our students go to work, and then there's a couple of scenarios where this could really become a positive feedback loop, but I think in the short term, it's really hard to say.
Thank you.
Do I have to use the microphone? Live stream for the World Wide Web. Beginning now. Good afternoon. Thank you so much for your attention. We are delighted to be here. Allow me to introduce my team. Janul Hernandez, Russell Carras, Juan Gonzalez Perez, and Sebastian Vanderzeel. My name is Dylan Lanius, and we are here to tell you a story about a university's response to divestment.
So the start of this story is really the context. It's important to understand where this question of divestment came from, why a subcommittee as part of the foundation would consider this, and then how it could be analysed and responded to. So importantly, the student government resolution was handed to the administration. The divestment research group recommended that divestment be explored. A subcommittee, which we're going to set up as being the first part of this presentation, is going to explore the issue and recommend a series of questions to Commonfund. Now, Commonfund's response as a service provider, which is as an outsourced chief investment officer, is to come back and say, here's what we've considered as a response to your request. So that context is critical because it's about the stakeholders in that process. Secondly, the start of any assessment should always look at the major factors and understand the aims. In this case, for the subcommittee, the investment subcommittee, there are really three levels of factors. First of all, the internal factors. There are a number of critiques provided by the investment committee, but primary among them are such as the capricious changing of foundation policy, as well as potential diversification issues. Secondly, at the micro level, which is at the administration campus level, student government resolution was passed significantly, and it's quite a powerful idea from the students. But to balance that is really this idea that there's a constrained budget issue. The endowment requires funds to do what it needs to do. At a macro level, there are a number of factors, but at a broad, but the biggest ones are the climate impacts as we see them, and the climate and the oncoming carbon regulations. So those factors form the basis. But let's explore also what are the aims of a foundation like GPSU's. Fundamentally, financial sustainability is fundamental. To support GPSU's faculty and students. But secondly is to respond to the student government resolution, the recommendation from the foundation, and thirdly is to respond to climate change.
So as GPSU, our call to divest is to cut off support for fossil fuel industry and uphold principles of justice and preserve a livable planet. So basically, we're agreeing that climate change is a major moral issue that we want to get into. But the big elephant in the room is, how do we do this as an endowment and still keep our fiduciary responsibility intact?
So we looked at three scenarios when we were analyzing the future climate risk and associated regulation. Our first conclusions were that there's a low probability that we're gonna delay existing regulation in the near term. Secondly, we also feel like there's low probability that we're gonna have a unified, cohesive international approach to provide guidance in the next 5 to 20 years. What we feel is a more likely scenario is to continue the path of regional divergence, where we have state, national, in some case, regional actions to help mitigate climate change. We see this as a gradual increase of risk, of climate risk over the next 5 years, with some significant events such as South Korea enacting the second largest emissions trading scheme in the world in January 2015. We also see actions by the EU ETS, such as reducing emission allowances, which could incrementally drive the price of carbon up over the next 5 years. The real risk comes at the inflection point between 2020 and 2025. One of the main drivers of this increased risk is China. According to 2 surveys conducted in 2014 by Point Carbon and the International Emissions Trading Association, industry experts agree that there's an 80 to 90% chance that China will have a unified carbon trading system by 2025. This is important for 2 reasons. 1, China accounts for 15% of global greenhouse gas emissions. And 2, the spillover effect is that this will have on putting pressure on the US, EU, and international community to enact more stringent climate change regulation. Now this presents significant risk for firms that did not account for this, as they'll have to deal with a short-term escalation in costs. We also feel that we also estimate that this will have the necessary investment, or require necessary investment of $2 to $4 trillion in the technology sector, which we see as an opportunity, and which is why we look to modify our portfolio today.
So what does this all mean for our investment portfolio, all these long risks, these extended horizons? To understand this issue better, we built a model that had 200 observations of a number of scenarios that could affect idiosyncratic companies, essentially, in our portfolio. And we looked at how these models, these scenarios, might affect their cash flows over time, since present value of companies is discounted from future cash flow. So the question is, how does the market react to all of this as it comes down the pike, as this regulatory coverage shifts and as these risks are realized? Typical equity analysts are looking at 5 years before applying a terminal value, so they're not actually accounting for these discrepancies in future cash flow. And when we modeled this for 10 leading companies, we found that there was a huge differential between their current market price and what their intrinsic value was. This differential skewed the risk-reward relationships. And as we looked over time at this differential, what it meant for the market, we found that there could be a significant repricing that we wouldn't be able to fully anticipate. We are risk-averse investors, we're not market timers. And so this led us to decide to divest. I missed that slide.
So on the basis of that idea that we're passive investors and we don't think that timing the market, so we're out of fossil fuels in time for this correction, we decided, based on that assessment, the decision to divest was made. And that decision from the subcommittee is really in the form of a request. What we're asking Commonfund to do is give us information, further information. So recommend on an investment process for GPSU. Manage climate risks and opportunities in the portfolio and investment universe. Recommend thematic investments. Advise on the best process and timeline for divestment. And also, in some sense, engage with the broader processes on climate risk, things like the Carbon Disclosure Project, Series Investors Network, as well as actively engage with the principles of responsible investment. No decision is made in and of itself, so it's important to understand what GPSU's decision would look like compared to decisions of other universities, similar endowments. Now, each have made their own decisions, but there is a best practice. There is a decision to divest or not to divest. But there is questions about, do you have a statement of responsible investing? Do you have an investment officer within your endowment which specifically has some skills in this area? And do you have a specific committee for addressing resolutions like that came from the student government? So investor relations and investor responsibilities. So on examining this framework, we need to also, as part of the investment request, go forward and develop our own policies. What's important about these policies is that they're about the foundation's contribution to the community of GPSU in some way too. While GPSU administration should pursue greening activities, energy efficiency on campus, all the elements that are important on that contribution to the emissions, the investment side is that they should be pursuing best-in-class portfolios, make sure they have an administration unit that allows students to engage, hire a specialized staff member to be able to just talk about these issues with donors, alumni, students, and other stakeholders, and develop a statement of responsible investing.
So what are the key recommendations that Commonfund must give to GPSU? First, it must have a clear mandate on divestment. Secondly, they must evaluate the risk and expectations on their portfolio. Third, they must take into account that some securities can be rotated really easily, like marketable securities, but they must honor capital commitments that they have, especially in non-marketable securities. Fourth, they must consider thematic investments and climate hedge strategies. All these four above must maintain the general asset class weightings. So we analyzed the performance and risk of the portfolio. Basically, we did an exercise going toward the future, doing a Monte Carlo simulation in which we used the Black-Litterman model to plug in our views. And basically, we had two views. The first view is that we will see a repricing during 2019 to 2020, in which basically fossil fuel companies are going, prices are going to be corrected as our DCF analysis showed. Secondly, we see also lower returns for this industry afterwards. The result shows that the expected return is higher for the divested portfolio, but we see also a rise in volatility. This is mainly due to loss in diversification. We also see that the energy index has a fairly high volatility and a really low expected return.
So in managing a portfolio strategically across asset classes, we have to look at how these issues might affect our overall portfolio and the different ways that managers are realizing return, their alpha, risk-adjusted return, or premia. And so we have to classify that for managers. Managers need to engage in that exercise, and they need to understand how climate change is going to impact their current risk premia. That dynamic is really critical, and it's something that guides our rotation and our thematic investment recommendations. So we've recommended that they rotate out of the sort of black box Global Endowment LLC into an S&P 500 index that excludes fossil fuel companies. This is essentially the benchmark without fossil fuel companies. And then we invest in proven asset managers who are predominantly investing in real assets, trying to get real cash flow realized, but allow that to be up to the ongoing process of manager selection as new funds become available for new capital. We don't want to rush that process. We also want to look at a climate hedge, which is a little bit of a creative strategy we came up with, a negatively correlated asset class, weather derivatives, that should benefit from any of these increases we're seeing as more and more people are buying and selling climate risk to manage their exposure. We also think that there's very good pricing right now, opportunistically, in some of the carbon finance and trading strategies that have some very nice positions in bespoke cap and trade systems, and there are a number of proven managers for those types of allocations, and that would represent about 10% of our portfolio. We would do this over this time period. In the first 2 years, we would have divestment from our marketable securities and the rotation into the recommended S&P 500, excluding the fossil fuel industry, as well as capital is available, invest in the thematic fund managers as they have funds that are open. We would maintain our non-marketable securities until that capital is returned to us, at which point we would consider where to deploy it. We also will engage in this process, with fund managers, explaining why we're divesting, share with them our thesis, and allow that to permeate the way that security analysts look at risks in the market. So essentially, Commonfund is going to move forward from this lesson with GPSU to join the Carbon Disclosure Project, Series INCR, and deepen its UNPRI contributions. Also create an initiative to advise security analysts on how to model climate risks, these extended cash flow discrepancies that might occur, and work that into present valuation of securities. We also will design a climate risk and investment premium evaluation process to apply to fund managers, so they have the capacity to understand what's going to happen to their alpha, their edge, over time. And then also to support GPSU unequivocally, but to also look at the ways that it can engage in the climate and divestment debate with other clients. Thank you so much for your attention.
Could you just spend a minute on page 10?
Page 10, yes, sir.
This is another German chart.
Oh yeah, so this is one of my favorites. So, what would you like? I could explain this a bit. So we had 20 scenarios here. So I basically took 20 scenarios where I was modeling how those scenarios might affect free cash flow over time. And this was based actually from work that Bloomberg did. So that was the basis. They had a tool that they created, and they had like 2 scenarios or 4 scenarios, and I just sort of extrapolated that to 20, and then looked at what that would mean for share price. So I'm making it sort of a dumb model because obviously management would react if you have stranded assets or if you had any of these regulatory shifts. So I'm making a lot of assumptions here, but it just goes to show the sort of the risk-reward relationship. It's an indicator more than anything else for us.
Have ConocoPhillips going from $72 to $1.
Yeah,
what was that about?
That's pretty crazy, right? So yeah, I mean, so this is actually basically a so this is like Q1, Q3. So the first and third quartiles essentially. So I took out the others to get these values. So it's actually worse if you see the original model. That's like that for most of these companies. But I thought just to be conservative. So basically, I think this is having to do with the fact that their reserve replacement ratios, they're not coming in and reinvesting. So Exxon has a lot more booked reserves, and so I think that's what this model reflects. Because I just plug in their sort of free cash flow on the top, and then the model runs out with a coefficient.
Can you just explain that for a second? So are you saying that the company would virtually almost go out of business, and there'd be no book value even to buy?
Yeah, but so it's a dumb model, right? It's just something to give like an indicator.
Let's just presume it's smart for a second then.
Right.
Let's just say you gut ConocoPhillips. And it's
If
sort of the Lehman Brothers of the energy. I'm presuming that's true.
Yeah.
Did you also model Gazprom and OXO? Because my question is, what do you do to international energy companies, let's say based in Russia, near the Ukraine, right? And since 75% of the carbon risk are government-owned reserves, and you got the cash flow of Russia, what are the scenarios around that?
That's the real question for the carbon bubble, right? Because governments are deriving revenues from fossil fuels like Saudi Arabia and Russia in an international agreement. They could always tank it. So that's part of the question, I think, for the world. And the reason I didn't model those companies because we're working off the S&P 500 index, essentially. And so these are 10 leading companies representative of their industry in the S&P 500.
If S&P 500 is 50% international, and a large part of that international is European revenue, and European revenue is sourced from natural gas from Russia, isn't that a strategic risk?
So let me see if I understand exactly what you're saying. So you're saying there's a risk in Europe from nat gas from Russia. What's happening to nat gas from Russia?
Vladimir Putin could turn off the spigot to nat gas in Europe and crush the economy.
Yeah. I mean, so this is a big question about how this forecasting or how this type of valuation affects the broader market as a whole, right? I mean, these are a big constituency in the S&P 500. So we expect, actually in our modeling that Juan did, when you see a decline in the oil and gas and coal sectors, you're actually going to see a decline in the market portfolio because there's all of this reliance, such an integral part of the economy, the correlations that he built in on the covariance of the last 15 years. So that's a very important consideration, and that's why we actually took that into account for our forecast of how the market would do. This valuation work came because we were looking at this at the S&P 500. It'd be interesting to look at Gazprom, it'd be interesting to look at these companies. It would be interesting to be more surgical with how I looked at, ConocoPhillips or, how I looked at any of these companies, but I was trying to create just like a broader swath. I mean, I could have done like a confidence interval and try to find the true mean, and that would have been interesting, but I just was a little pressed for time. It would have been better.
Well, you talked about, first of all, number one is that you have a divestment strategy from fossil fuel companies, but then you talked also about climate hedging and proxy voting. And so if you're divested from a fossil fuel company, you don't have a proxy vote there. So you're talking about elsewhere? What are you talking about?
Yeah, so I wrote that at 4 a.m. when I was feeling really excited about divestment. And I know that a common fund probably wouldn't want to say we're unequivocally supporting this issue. I don't know if that's common fund's stance, but we were saying for our divestment move, we want common fund support, essentially.
And I think the stakeholder engagement issue is critical, and we still own the rest of the S&P 500. And we've talked about utilities, and we've talked about manufactured gas, and so we've got emissions, we've got the rest of the carbon emissions, like the rest of the CO2e, not just carbon dioxide. We've got methane and hexafluoride and the rest of them. So this is really about, this is ongoing. We've just put a stake in the ground with divesting fossil fuel reserves, and this is evolving, in some sense.
I just have one other question is on a lot of the other teams talked about green bonds and the fixed income portfolio. I was just curious if you thought about making any changes there.
Yeah, so that's an interesting asset class. I think the asset class has really low returns, actually. I think we're misrepresented in some of the slides some of the other people have used. And I would consider that with fixed income, certainly, over time. But that wasn't our primary consideration. Our primary consideration wasn't to get as much sort of climate impact leverage. We did decide to invest $38 million. We rotated 75% of the portfolio. But we said, hey, we're just going to keep our fixed income because it's clean, it's performing. That's great.
Did they apply the Litterman Index accurately? When's your Nobel Prize?
We got here. We got here the assumptions at the end in the appendix. If you wanna check the appendix, you will see basically the detail on the assumptions. So
I'll ask a different question on the model. So there were 2 oil shocks in the 1970s. Did you guys use that as assumptions for your models?
Yeah, so if you look at the modeling, it's actually, we considered oil going to $200 as well as $150 and holding it there. So we held it there actually for like 15 years. So it really affected the valuation of some of these companies. That's what you see with sort of the positive side. And you also see that with why some of these companies are like just hit it out of the park, Schlumberger, Exxon, that really helps them. So they got a lot of the upside on that, which is, yeah. Thank you, guys.
We're very happy to be here. Let me quickly introduce our team. There's Sid Venkatesh, Marcelo Gomez, Gary Top, and I am Francisco Vasquez. So I'm going to start with a story. When we first went into one of our classes of microeconomics with Professor Murphy, he told us, if you give people a way to lose weight quickly, you'll just have a generation of obese people, because people like to eat junky food. Well, here we are facing a similar situation in which investors want to make returns, but we know that carbon emissions aren't the way out of this problem. So the way we frame this is by analyzing the different foundations in which society allocates their investments We have political foundations, we have moral foundations, we have economic foundations, and in particular, we're gonna assess a framework and a solution for two actors. There's GPSU, that can be a potential university endowment or university with an endowment, and then Commonfund, that is the endowment manager. And ultimately, we will come with a result for the asset allocation. But first, a quick introduction on these foundations that we are considering. So on the moral aspect, we have to consider the fiduciary responsibility and what is good to do with those assets, and to what point we can divest them if that's the wish of the donors, and why not divest from other sectors that we know are bad, for example, junkie food. Even especially taking into account that no laws have been passed and therefore society hasn't said that these assets are bad. On the economic side, our consideration is to preserve the current view of the market. So we want to preserve the incentives that investors want to maximize the returns, with, of course, a long-term view in the case of endowments. And on the political side, we believe that there is a change to be done, and that at some point laws will be passed and assets potentially will be revalued, but that will come hopefully in the near future. But as you can imagine, this is a complex problem, and with that, I leave you with the rest of the team that will explain.
So I would like to talk about stakeholders, objectives, and alternatives. Clearly, a university is a complex institution. It has multiple stakeholders. They often have conflicting interests. Turning specifically to GPSU, we can see two sides with two different interests. We have students who have been, who through the student government body have mandated the university to divest from fossil fuel investments. This is part of a larger movement through 350.org that has moved across endowments across the country. Secondly, and on the flip side, we had corporate donors who provide a large amount of the funds for the endowment from operating in the fossil fuel industry. In addition, they provide employment for alumni of the university. And they also, play an active role in maintaining the community of which the university is a part. Our preference is that, and our recommendation is that any strategy has the agreement of all stakeholders. So moving on to the objective of divestment. If the objective of divestment is to change firm behavior, then we don't think it's necessarily possible, or we don't think it's possible for GPSU. The endowment is exceptionally small compared to the total market capitalization of companies. In fact, the total assets under management for all endowments in the United States is small compared even to the total market capitalization of the oil and gas sector. So if they divest from particular companies, we don't think it will change firm behavior. There's always another investor who is willing to step into their place. Additionally, if they do divest, then they lose the ability to influence those companies through engagement. What's more, there's also penalties. So one of the penalties is lost diversification, potentially lower returns, certainly increased risk, and probably lower liquidity as well in the portfolio. We think really the only impact that they can have by divesting is the signal that they send to other institutional investors and other endowments. And just finally, we also considered other alternatives aside from the endowment. We considered maybe they can create a green impact fund within the university to potentially invest in maybe clean energy businesses in the university. They could perhaps let students manage that. They could also invest in more R&D in the university in clean technologies. So this wouldn't be using the endowment. This would be using other funds within the university to tackle the problem. So to our solution, or to our answer, we think the GPSU should frame the decision around stranded assets hypothesis and simply around maximizing risk-adjusted returns, given what we expect to be a transition to a low-carbon economy by 2050, and we're looking over that time frame. We expect that companies that have large exposure to fossil fuels, and we'll discuss how we calculate that later on, will underperform the broader market during this time because they won't be able to access or they won't be able to use all the assets that are currently on their balance sheet. In addition, we expect there to be growth in low carbon industries, in renewable energy, in green industries. We expect probably, from what we've seen in projections, at the moment, renewable energy contributes 10% of the global energy mix. We expect by 2050 that could be 30%. And as I think has been mentioned, the nature of innovation, the nature of technological innovation is that it can be revolutionary. Once it reaches a tipping point, it can happen very quickly, and we've seen that in information technology and mechanization in the industrial revolution in the 19th century. So we think that we should focus on maximizing returns, and we think we can do that by reallocating the portfolio to capitalize on the changing energy mix over this time frame. And we actually think this solution provides some neat answers. One, to the donors, it says, you know, we're not going to penalize you because of we're not making a moral judgment about you. We're not going to penalize you because of the industry you operate in, but we will penalize you if we expect you to underperform the market. So if you have stranded assets, then you may get penalized, but we're not making a moral judgment about your industry. And additionally, we haven't answered the slippery slope question. We don't need to divest from other sectors unless we feel that they will also underperform the market. So for example, the fast food sector, as Fran mentioned. And finally, in terms of carbon tax, which we think is the most efficient way to tackle the externality, which is carbon emissions, we're well positioned if any legislation comes into play. If there is a carbon tax, we're well positioned to benefit from that, because companies that are in green low carbon industries will outperform if there is a carbon tax.
Thank you, Gary. Hi. So endowments, they typically like to diversify their holdings so that they can take on as little risk as possible. So there are a couple of different couple of different strategies for the common fund to rebalance their portfolio. One is exclusionary screening. In exclusionary screening, the common fund can decide not to have any positions at all, either in a few companies or in an entire sector. However, we believe that that is not the best way to go, because fossil fuels have been an integral part of the portfolio for a really long time, and completely moving away from it can lead to real imbalanced portfolios. We also believe that fossil fuel assets provide an important source of liquidity and diversification. The other method that we looked in was weighting. In weighting, we can actually have holdings in different companies based on a carbon profile. Now, the carbon profile is basically just a ranking which ranks companies in a particular order. Now, there are certain organizations that people have spoken about which give you like an index, like a carbon index. But we believe that a lot of the inputs that go into building that index are taken from the companies themselves. So companies provide the numbers, and these other organizations use those same numbers to rank them. And we feel that is not an accurate way of doing it. And therefore, we've used a factor fuel beta as our method for ranking companies. And I can just quickly explain to you what that's done. The third strategy that you could use is impact investing. In impact investing, so there have been a lot of investment funds that invest in companies that proactively make changes in that take proactive steps in addressing climate change. However, this is still in its infancy, and we believe that there's a lot of government-related subsidies required, and so the sector is small and it's illiquid, and therefore we suggest that we suggest that Common Fund can also invest in green bonds and climate bonds instead of directly investing in the companies themselves. So we've used the fossil fuel beta as a market-driven way to assess carbon intensity. The beta is basically it is a factor which tells the co-movement of the stock price with respect to the fossil fuel prices. So by ranking them, you can actually see which one varies the most. And as expected, we see oil and gas and petroleum companies, which are right at the top, and going down, we see tech, pharma, and other companies. So this is an interesting alternative. So here the weight is actually transferred from carbon-intense industries to lower carbon industries. And we calculate so we are given 10 different sectors, and we've calculated a sector beta for each sector by doing a weighted average of the individual betas for companies. And for the weights, we actually use the market capitalization, because we feel that so this is the right way that investors are evaluating the company. And the other important thing we wanted to stress is that we want to use a gradual divesting approach. a significant portion of the assets are in the alternative assets category, and we do not want to divest away from it immediately because it's illiquid, and we do not want to take any kind of penalties or losses that would be involved in exiting positions here. And it's necessary to consistently monitor the portfolio and also the regulatory environment. Now, since we have advocated a change in the fixed income and the equity section, we believe there should be a new benchmark which actually reflects our opinion of the investment. The old benchmark you can see is on the left, and we've created a new benchmark which comprises about 10% in a green, which is a combination of green bonds, climate bonds, and a green index. And we believe that this benchmark is specific. We would like to have it in effect as early as possible, say January 1st, 2015. We believe it is specific. We believe it is measurable, and we believe it correctly represents what we think, where we think the investments should be made. I think Marcelo will take over there.
Okay, so we're still talking about like changes in the portfolio. We want to mention what happens with the alternative investments. So the commodity and natural resource we consider reducing for 50% of the investments, and we want to keep it in the portfolio for diversification reasons or like a hedge for inflation, for example. The private equity fund, we believe that they are soon, like we're gonna get their maturity because of the vintage year was on average like 2007, so it's 7 years ago. So we expect to have these distributions funds to be reallocated to the green funds. Green funds are those investments that not necessarily mean clean tech or clean energy, but that has a philosophy of investing green. Like for example, the KKR portfolio that thinks green, and they reduce costs and they improve their revenue, so they have more profitable investments. So we believe that in the future, considering this new allocation we're going to provide for our fund, we see that 2 new challenges will come up. Like the first one is availability of fund managers, that we believe that some fund managers will be afraid to have a bad track record in their portfolio, so they will sometimes avoid having those type of investments. And we can understand them. They are also risk averse. So it's even funny to see this way. And the other thing is about portfolio monitoring. There are a lot of new inputs that we're going to see now. We have the climate impact damage. It's a real input. For example, in Brazil, now because of lack of rain, the hydroelectrics are not operating very well. So we are having we increased our costs in electricity. So this is a real impact. And students can be involved in this matter because they could develop and they can bring new energy for those new frontier of knowledge. And as conclusion, we believe that endowment funds should focus on achieving maximum returns for stakeholders. And students can participate on this and achieve impact on this. Returns can be maximized by rebalancing the endowment funds, and this is one of based on the idea that there are stranded assets. So on the long term, we believe that our portfolio would perform better. And legislation and new green opportunities are surging, so we need to monitor the market, and at the same time, we have to keep flexibility in our portfolio management because we need to act fast when those changes come. So there's no right or wrong solution here. We came here with an individual's idea, but ultimately society will decide as a whole which solution, which model we want. Thank you very much.
Yeah, I would like to open the floor to questions, please.
So did you think about engagement strategies at all and consider what role you think Commonfund and GPSU should have?
Yeah, absolutely. We did think about engagement strategies. I think, I mean, we had probably 2 conclusions. I think one, we could go for a pure engagement strategy. But to be honest, we feel like the endowment is, it's so small. They're holding positions in diversified funds. We really don't think that they, have a very strong position to engage with companies and to force change in firm behavior through engagement, because simply their holdings are so small, and I think that's the reality. Secondly, I mean, we did realize that, if you divest completely from a company or from a sector, you really have no voice in that sector. So that's, one of the drivers for why we wanted to maintain our position there. We don't think it's necessarily going to be a strong voice, but at least it leaves us with a position to opine.
Yeah, and at the end, I believe that there are two ways of engaging. So one would be through stakeholder participation in companies. As Gary said, we think that that might be a bit out of the competence, both of the fund managers and both of the university. And on the other hand, I mean, all of us are responsible of engaging through our society role, and that is voting and deciding what laws we want to be passed. And we believe that that is a kind of engagement that we are assigning to the whole university body.
You spoke about a low carbon index. Are you looking at, or low carbon investment in public equities? Kind of force ranking. Did you do any work on that in terms of looking at the impact of that on kind of total return or total risk?
Right. So basically, there was a study by the Aperio group, if I'm not mistaken, which is part of the data sets that was given, where in different countries they took they measured the returns of the whole of the entire market, and then they started removing all these the stocks which are high in carbon. They started removing that, and when you observe the returns of the new portfolio, they're very similar to what was the return of the entire market. Now, the additional change that we made here was that if you use the fossil fuel betas in order to rank the companies, so for example, the higher, so petroleum and oil and gas give real high numbers. So if we decide whenever we want to move away from the sector, we look at what sector was lower on the rankings, and we could actually invest in those sectors, instead of the original ones. But the work was done by the Aperio group in estimating the returns.
How do you think the client will react when we say, don't worry about it till 2050, because we'll beat the world by 2050?
Yeah, I think Gary will certainly add more to it, but I think we have proposed that we will be constantly monitoring the portfolio. It is not going to be a case where the client does not know what is going on. We can clearly track the portfolio. The numbers we have assigned, we think will change over time. So the 2% that is there, if that part of the portfolio performs really well, we will probably invest more into it. But I think Gary can.
No, sure. I mean, I think the 2050, I think we're just really trying to make the point that we're looking over a long time horizon. And in that time horizon, we expect to see, potentially quite big changes to the world. I mean, I think probably, we didn't expect that this week at the APEC summit, Barack Obama and Xi Jinping would be making, announcements and agreements on peak carbon, on cutting carbon emissions. So I think we could really see a rapid transition in that time, and I think we're really just placing this in a time context, and we expect within that time context that there's some big changes could happen.
So first of all, I just want to acknowledge that the home of Milton Friedman, Harry Markowitz of Modern Portfolio Theory and Efficient Markets, that you're representing that school to be here. So I want to acknowledge that. And consistent with that, you talked about externalities and society will decide, but you also are promoting a carbon tax. So I find that interesting. So my question is, what sort of modeling of markets or interventions did you do beyond just society will decide, including everything from, couldn't the university approach a corporate donor and do a joint university corporate center for future energy, physics, and the quality of life? Or at the University of Chicago, it might be named the Center for Eliminating Inefficient Markets and Suboptimal Behavior. But what sort of modeling of markets did you do, not just the portfolio?
I mean, I think the clear model for this is, an externality and a Pigouvian tax. So our belief is that, externalities that have a negative impact on society should be taxed.
But isn't tax interfering with a free market the essence of your school?
I don't know. No. I don't think that's necessarily the case. I think that's maybe probably a misunderstanding of the free market. I don't think that's regulation. I mean, I think that's actually efficient. It's actually efficient to tax something that's an externality. So I think.
Is it consistent? I don't mean it to be mean. I mean it to be constructive.
No, it's all right. It's all right.
But isn't it? How is it consistent with efficient markets? That the fundamental underpinning of economic is.
It's I think that at the end we want So the efficiency function to try to represent the best society to maximize that function. And if we acknowledge that this model is unsustainable, I mean, we have to try to describe in a best way the model that we think is sustainable and will still keep the right incentives for investors. That's what we're trying to convey.
So you talked about the penalties for divesting being a loss of diversification, lower returns, and increased risk. You didn't really define what you meant by risk, so if you could talk a little bit about that. But then you also go on to recommend a divestment strategy, albeit a gradual, partial divestment strategy. So how do you reconcile that?
So can you move to the slide like 5 or 6? Yeah, previous one. Okay. So basically what we are saying is that, so there are certain sections, for example, the alternative asset class, that we decide we are not going to divest away from it. The reason being, we believe the GPSU is really looking for a long-term horizon, and we believe that the penalties or the losses we take if we decide to divest from it right now is really not worth, it's really not worth absorbing those losses, because we have a long time horizon, and this is something we can continue to monitor over time. However, our belief is that, so we want our new benchmarks to reflect what our investment opinions is, and we really believe that the world is moving towards a more, a better environment in terms of carbon, and that is why we've allocated 10% of it to the green bonds, climate bonds, and the index. So we are diversifying away only a part of it, and the non-diversifying part, it appeals to a little bit of the alternate asset class.
Yeah, so you've said you don't want to divest from fossil fuels for moral reasons, but suppose you found that, say there was a company that was funding misinformation in order to prevent appropriate regulation of emissions. Would you consider that something that you might find objectionable?
Well, I mean, I think probably in that circumstance, if I understand it correctly, probably the litigation that company would face would cause them to underperform the market. I mean, if I'm understanding the circumstance correctly, they're behaving in an illegal manner. Probably there's going to be litigation. Probably there's going to be negative reputational effects. So, I mean, I think it would be absolutely consistent with our view of, having a portfolio that seeks to maximize returns, that we aren't invested in a company that's, has high litigation risk, that has high reputational risk. So I think it's consistent, yeah.
Thank you. Yeah. Oh, and sorry. After all, we are certain humans, and if we know that there's a law and that the company is breaking the law, I would suggest the university to divest in that case. I mean, even though it would also be impacted by the market return.
Good afternoon. My name is Pauline. I'm going to introduce my teammates, June, Matt, Katie, Darius. We're the team negative 44.01, and we're going to present to you as the story of GPSU endowment and our solution to the question of divesting from fossil fuel companies. So on this slide is a view of a survey that has been made among CEOs, and that give you the key drivers in their mind for employee success. And with this in mind, because they emphasize on ethics and values, collaborative environment, purpose and mission, keeping that in mind, GPSU University, as the educator of the future leaders of those companies, has to make a statement and position itself. That's include answering the question of divestment. The university stakeholders, which include the students, the administration, even the future employers of the students, have all taken a huge interest in this issue. And for this reason, a strong message has to be sent, mainly considering the recent fallout that has in the university that have in the past tried to answer that question, and also considering that the media and campaigns are putting this message to the extreme. So our main Okay, sorry. Our main message is that the university should use all its resources, from the endowment to the student population, to implement and scale sustainable solutions. Our proposal is, first of all, to divest through a unique mechanism of a set of criteria and reinvest to optimize the portfolio with investments in companies scaling along the growth cycle. And number two, to create an alliance, to create value and opportunities by pooling resources and shareholder engagement with similar-minded universities. Here's our agenda for this presentation. We're going to first present to you the divest to better invest strategy. We'll move on to the coalition building part, and we'll finish with the implementation. First of all, I'm going to answer the question, should we divest? Our answer is yes. In order to send first a clear message, to direct campaign pressure, and to most of all, create opportunity to higher profit. And I'm going to pass on to June, who's going to explain to you how we're going to do that.
So next question is, can we divest? Is it really feasible to divest without hurting our their portfolio's performance? If you remove the fossil fuel assets and relocate those assets to other current assets, and if we generate new portfolio without any fossil fuel investments, and which maximize the expected return, this portfolio will be the new portfolio, and the expected return actually outperforms the current portfolio's expected return by decreasing equity. Public equity includes these fossil fuel assets, and by increasing real assets. So if you can divest, is it really okay to invest those money to any new investments such as renewable energy? So if we, so our answer is also yes. If we optimize our current portfolio, having constrained with minimum and maximum asset allocation, our new optimized portfolio's return will increase having the same amount of risk. And this new optimized portfolio will have 2% of renewable energy. So this shows that you can not only send powerful messages for sustainability by investing in renewable energy, but also you can increase the performance.
So we propose a divestment mechanism that is a little bit more delicate than the sledgehammer, if you will, of total immediate divestment. And I'm going to explain what that mechanism is. First off, we want to prioritize our divestment targets. Ultimately, we do want to completely divest from stranded asset risk, but we're not trying to divest from fossil fuel companies. We're trying to divest from that risk. So we want to prioritize within these sectors the targets to divest from first, and then announce a timed and pending divestment from those companies conditional on some criteria. When we do that, we expect that companies will either continue business as usual, in which case we will divest from them, or the companies will take action, whether as a response to our initiative or as a response to other market forces. And if the companies do decide to take action, first, as a university, we want to offer to engage with them with all of the resources, our students and faculty, with partnerships and collaboration. And then we also want to involve our students and faculty as a part of a practicum course to determine what those criteria should be at the end of that 4-year timeline. And at the end of that 4-year timeline, we'll apply those criteria and remain invested if a company meets them, and if not, we will then divest. I want to speak a little bit more about the metrics that we're going to use to prioritize these efforts. And the metric we want to use is CO2 intensity per unit revenue. It's important to note that even within the energy sector alone, there's a 10-fold difference in CO2 emissions per unit revenue. And we think it's important to use that metric to prioritize the order in which we apply our divestment efforts, because that metric is financially sound. The risk from which we're trying to divest is based on carbon intensity, and divesting according to carbon intensity will make sure that it's the most financially sound method. It's also justifiable. We really want to emphasize our engagement with these organizations, and we need to have a quantifiable metric to explain to these organizations why we're having this conversation in the first place. And then it's also impact maximizing. It's important to remember that this conversation is also about climate change ultimately, and focusing our divestment efforts on the most intense emitters means we get the highest return from our efforts in climate change.
So now the question is, how do we reinvest our assets? And we've decided to divest because for three main reasons. One, we can de-risk from our assets right now that are exposed to carbon regulation. We can reinvest, or we can also reallocate our assets in accordance with our morals and send a very strong message. And third, we can also achieve a higher return. So, but we also recognize that a lot of our critics might say, by divesting, you are actually not making an impact on the target company. And what we think we're proposing is an innovative way to try to really maximize the process and really try to turn the, point the needle. So what we then challenge ourselves to do is say, is there a way that we can really maximize the impact that we have when we reinvest as well? And so what we would like to propose is that we reinvest along the growth stage. So not just reinvesting in venture capital funds or in equities that are already on the, in the market, but instead to really focus our reinvestment along the growth cycle. So we propose doing that in three main ways. The first is to invest in direct assets, and so that includes things like water, timber, and other resources which tend to follow the same cycles that the fossil fuels that we're divesting from tend to follow as well, because they're responding to the same drivers like industrialization and development. And the second is to invest in early stage companies, and so these are really helping to help companies take good ideas to the market. And so these would be by investing in things like venture capital funds or growth equity funds. And then our third recommendation is to also invest in late stage funds. And so this would include things like project finance funds or equities for, successful companies like SolarCity. And what we think that this will help do is then help those companies who do have a successful product scale it so that it can actually be a sustainable solution. So what you see in this slide is that depending on how we invest in these different assets, we can see very different returns. And so this is where we rely on Commonfund's expertise as asset managers to really decide how to do that strategically. But as we saw in our original analysis, we think that there is a real opportunity to, in this sector, for these returns to grow, but also to start investing in these type of investments right away.
Hi, so we talked a little bit about the financial justification. I think it's important that we kind of return to the basics and fundamentals of an educator in the sort of example we're supposed to set here. And I think in terms of the finance, so the numbers, we also need to make sure that this is consistent with our actual implementation and really what our mission is as a university. So we feel that GPSU's really mission statement should be innovation, collaboration, and transparency, because on top of the financial justification, we also look at how do we scale this, how do we engage our students, faculty, and peer like-minded institutions. So one of the ways that we've thought about doing this is actually setting up a lessons learned information repository that'll work as a database that's searchable, that's decentralized, and allows students from across the country to contribute. And I think these lessons learned will also be able to sort of prevent redundant practices. It'll also allow people to learn from each other's mistakes and gain buy-in as stakeholder engagement increases. And it'll also set GPSU in terms of leadership. It'll train their students for their jobs upon graduation, and this will also have a scaling effect where we'll be able to get to the scope we need considering a small university endowment.
And the second part of the coalition is made through shareholder engagement, which is a key aspect of our time-conditional divestment strategy. So here we play on, first, the role of institutional shareholders that are universities. They are key corporate engagers, and their role is to pay attention to financial results, of course, but at the same time, to the way that companies are managed. Then this is based on the power of the coalition, because, first of all, because of the size of the endowment itself, and at the same time, meaningful change only happens when shareholders are in broad agreement. And third of all, from the industry perspective, it should not be underestimated the impact of environmental, social, and governance factors on corporate financial performance. So looking at that, here's a very simplified view of the shareholder engagement process through first a public way of filing a proposal and a more private way of directly engaging in negotiations with the management board. We recommend the following strategy. First, for the university to identify the potential partners by working with Commonfund to find universities that are in the same portfolio, for example, but also outside of this network. The second step would be to organize the network itself by proactively communicating with the universities that are identified as potential partners, to then engage as shareholders. We recommend to first engage through a private negotiations with the boards, and to move on to filing a proposal if this is unsuccessful. And here the goal is, one of the goals is also to show the students how to engage with businesses, and so this is why we would move to shareholder engagement.
So the final step is going to be implementation. And how do we actually, how does the rubber hit the road? So the first is through a timeline, and we see this really being 3 clear steps. The first is the strategy. This would probably take about a year to really figure out what is our divestment plan, what's our criteria, and then also to build the University Alliance platform. Then the second step is engagement. And so this is going to be when we engage the companies that we have told we are going to divest from unless they meet our criteria. And then also to really engage with the universities to make this resource of peer-to-peer sharing mean a lot more than it is just as a web platform. And then the third step, third stage, is to move to action. So this is when we divest from the companies that have not moved in the direction that we have set forth. And when we also work to really strategize with those universities that we've built relationships with on how in aggregate we can take action to start making the meaningful changes in the future that we want to see for ourselves and for our students. And then going forward, we want to continue to work on solutions that move markets and also to maintain Gifford Pinchot's role as a sustainable leader. So when it comes to costs, we've done out a basic estimate of what we think, and there's 2 main takeaways. The first is that these costs are nominal compared to the impact that we think that this will have both on campus and off campus in the market. The second main takeaway is that through this collaborative platform, we think that we can reduce a lot of these costs because we are inviting others to participate with us. So for example, if Commonfund does make this a raise a fund or start investing in these alternate assets, we can invite other universities to participate with us and then share the management costs among them all, similar with the shareholder resolutions. So really, in conclusion, this is our plan for action-based leadership. And we think that through divestment and reinvestment, through shareholder resolutions, and through resource sharing, we can make a big impact within the resources that Gifford Pinchot has to offer. But if we really want to amplify the impact that we can make, then we need to both inspire and invite our peer universities and institutions to stand with us at the steps that they're willing to engage with us on and willing and able to, so that together we can collaborate and really take the ideas that we want to see to scale. Thank you.
If we can go back to the page where you had the asset allocation changes that you made. There you go. I just wanted to get a better understanding when you took down your public equity quite a bit and you raised your real assets quite a bit and also your distressed debt. In terms of your real assets, one question there is that liquid or illiquid? So what are you doing there?
It's illiquid assets they already had in their portfolio. These are current assets their GPS is holding. So
I'm looking at your new portfolio, so the two from. And I'm curious, you have another slide where you look at your correlations. So I'm just curious, where you've made pretty big swings between your asset allocation from where you were to where you are now, what kind of investments are you thinking about making in terms of the illiquid versus liquid balance in the portfolio, as well as sort of the overall correlations?
Actually, it's really hard to calculate the illiquid assets standard deviation. So this is just maximizing the expected return analysis. So the next page, this one is the one that I use the correlation data. So because GPSU used the benchmark for using the market of data. So this one, I calculated the correlation and what impact might be on the portfolio. So to answer your question, it's really hard to manage how should we invest in market of data and non-market of data, market of assets.
Clarify. So I guess what I'm getting at is on the real assets, your allocation goes up a lot. Are you just shifting into more like natural resource equities, or are you going into hard assets, real estate?
So yeah, more of real estate. So that's what they have already. So this is not a new asset, and this is not the market of asset.
I also think it's worth noting that the reason that we did these two slides was to test kind of the boundaries. What happens if we go forward with this plan? So one was kind of to say, if we take away these assets from our current portfolio and just reallocate, what happens? And then the other was to say, if we add to it, what happens? And so it was very hard, as we went through this process, it was very hard because we weren't given that much information about exactly what they were invested in. We were given some numbers, we were told what general classes of they were invested in, and some percentage that was going towards currently natural, like the oil and gas sector. So we did the best that we could, but I think what we are mostly trying to demonstrate here is that we think that there really is an opportunity to get higher returns if we do this, and we really don't think that it is going to pose a significant risk to us. In fact, it's going to de-risk us from our exposure. So.
I'm just still confused. What's the difference between the previous page and this page in terms of, because one shows a 20% drop in equities, it's down to 45%, and this basically shows a 1%.
These two slides are totally different analysis. So this is one I use the data they disclose for the real assets. They so for example, for equity or public equity and public equity, they disclose several assets in those asset classification. But the next page is just a benchmark so that you can calculate the risk using historical data. So that I can compare. So the first page is just demonstrate how divestment is impact on the portfolio. And next page is just if you want to include some new assets like renewable energy, what kind of impact might you expect?
So are you saying that you didn't consider the risk side at all? You really only looked at returns in assessing what the appropriate asset allocation is?
This one, yes, but next one, no. Yeah, I consider the risk side.
We weren't provided with the risks. We weren't provided with the risk for the initial portfolio, so it was really hard to do. I think we had to make, right, in terms of for the first slide. Oh, there's one. Yeah.
So I notice you have this innovative metric of energy per unit of revenue, emissions per unit of revenue. I mean, but are you there talking about the emissions from the production of that company, or the emissions, like if it's a coal company, you're talking about the emissions that come downstream from the ultimate user of that energy?
So the tenfold difference that I spoke about, that is Scope 1 and Scope 2 emissions, so not including the use of the sold products. So we use that metric as a little bit of a proxy because Scope 3 reporting is not very widely available right now. So we focus on that Scope 1 and 2 because we're also considering companies that have at this point relatively similar business models, and we think that those companies, the extent to which those companies realign their business models towards less intense extraction, that the Scope 1 and 2 emissions are also going to follow.
Hey there. I just want to call out how inspiring it is for you to lay out the coalition building, which at least is unique among the finalists. So that's really compelling. And did you think about how you might do that? Like, are there alumni, undergraduate alumni who are on boards of other universities to find some natural network for that? Did you think about how you might build that coalition?
I think what we saw is that the platform would probably, first of all, you'd start to see communities bubble up because you're going to start to have, for example, operations people who are starting conversations about operational efficiencies. You're going to start to have maybe a divestment and investment conversation going on. So I think that will naturally start to coalesce. And then, relationships can also be built around things like, as we said, through Commonfund, who already knows who's investing where. And also because, as we saw on, this is kind of a small world in many ways. So there's a lot of exchange of ideas. So I think what we see is that this is a platform that we think will be flexible and will help kind of create that community that will then allow those kind of connections to occur.
And I'll just say the natural differences among universities will cause sort of a convergence to using a platform because, other university skills, faculty, university student disciplines will complement each other. And I think that, by creating a cooperative landscape where you can really learn from one another, sort of reduce some of the inefficiencies that are caused by repeating the same mistakes, but at the same time, trying to differentiate yourself as a university and competing with one another, I think will create a healthy environment that'll step outside of their own institution bubble by connecting with their region and hopefully the larger country. And I think this is really what's needed in order to get this movement to have a real impact.
The other thing I was going to say was that there's one person that we are recommending be the administrator of this and kind of manage. And I think that person will kind of become the facilitator of the conversations that happen online and offline, and also be the person that we would look to organize these alliances. If I can just say one quick thing to your your question about risk, we did think about that a lot. And what I was trying to say before is they didn't provide us with the exact levels of risk for each of the investments. So it was hard to know that exactly. We did figure that by just simply removing our natural resource investments, that would, and reallocating them, that is fewer assets. And so that's probably going to be more risky. But we couldn't quantify that exactly. So we tried to offset that with our investment strategy through things like trying to invest in direct resources, which follow the same cycles. So that would kind of replace some of the positive growth, and then also by trying to invest in a wide array of options so that diversification would again offset some of the risk that we couldn't quantify but we know exists. Yeah.
Net Impact, the Yale International Center for Finance, and the graduate and professional school students. I also wanted to make a quick announcement that the transportation for this event has actually been offset by Trip Zero.